MINERVINI Volatility Contraction patterns, low cheats, whatever you want to call them, is the topic of this video. However, I'm going to take it one step further. I'm going to teach you about my preferred order entry method technique, which is buy stop limit orders with stop losses attached and then utilizing a sell limit order for part of the position to take all of the risk out. And you might be like, what's he just said? That's gone over my head. Don't worry, we're going to break this video down into two parts. The first part, I've got 4 charts to show you, which are VCP low pivots, and then I'm going to explain on TradingView where for me the entry would be, where the initial stop loss would be, and then where I'd be looking to sell part of the position. In the second half of this video, I'm going to be jumping across to interactive brokers and actually show you how I set this up, how I use a buy stop limit order, how I then think about where the initial stop loss is, how I then set the sell limit for part of the position. So if you were expecting a vague, fluffy video with some nice pretty lines of contractions, it ain't going to be like that. This is going to be very thorough, very in the weeds. This is quite advanced stuff. MarketSmith are the sponsor of this video. There is a discounted trial available in the comments below. So let's start here with BEBE stores back in the 1990s. Now, I'm not going to go really thorough, as I said, on the VCPs. I'll give you an overview of them. I really want to focus on the final part of the equation, which is actually like the order entry and then trying to take all of the risk out of it. But relatively new in terms of its IPO, acts pretty well here. And then it starts building this VCP, right? You have 1 contraction, you have 2 contractions, you have 3 contractions. Look at the tightness in price coming through. Look how the volume dries up. Look at just the tightness between the 1021 and the 50 SMA. That's the black, the blue, and the purple line. You can't get paper clip between them. That's really nice to see, but then it's also thinking about the risk coming through. This is a really nice shakeout demand tail and the low here as well. I've been teaching you that in other videos. So for me, the concept with these lower cheats and these cheat entries, I'm looking for what I call a trigger bar. Now, a trigger bar invariably is a very tight candlestick on a relative basis to what you've seen for the action of the stock and where the volume dries up as well. So the trigger bar for me enables me to create a more asymmetric risk versus reward trade. So invariably I'm targeting it through the high of the trigger bar with a stop loss a cent below the low of the trigger bar. Maybe it's a little bit more if there's like a key moving average and I want to get underneath that. But let's do some examples and it will make sense. It's also important to think about where I'm then looking to free roll by selling part of the position at a gain to take all of the risk out of the trade. Because if I'm targeting these lower cheats and these cheats, there's going to be overhead resistance. So then I'm looking at local highs within the base for where might price stall out, where is there going to be a lot of overhead resistance and trap buyers. Because then I could be looking to free roll into that, because my expectation is kind of like, well, this stock, I'm expecting it to pop up here and then kind of stall out as it runs into that overhead resistance and then potentially creates that higher pivot within the base. So it all feeds into the trade management. So it may all be going over your head. You may be like going, what? I'm about to turn off the video. I don't understand it. So let me slow it down a little bit and talk you through it. So here we go, BEBE stores, nice 3 contractions in the base, getting really tight along a clustering of key moving averages. The volume is dried up, and then we get this trigger bar. It's nearly an inside bar, but it's a very tight bar on a relative basis. So the higher the trigger bar there is 44.45, and the stop loss a cent below would be 42.95. So if I got filled perfectly, which you're not going to get filled perfectly, and I'm going to teach you in the next 3, and then when we go over to interactive and brokers, how I think about buy stop limit orders and the range, and then how I kind of then think about it for then free rolling the trade as well. So if I got filled perfectly a cent above, my risk on the trade would be 3.4%, which would be $1.51 risk per share. Now that's interesting. So 3.4%, look at this number up here. This is the ADR percentage, which is the average daily range percentage, and it's set to 20 days. So 6.77% at this time here, back in 29th of October, 1998, the average daily percentage range of the stock, excluding gaps, was 6.77%. Now, why is that important? Why am I bothering to talk about it? As a nice metric, I like to get my initial stop loss around about half the ADR percentage if possible, maybe pushing up to like 2/3, maybe if it's really, really tight, maybe it's like pushing up to it a little bit. But I want to be trading the quicker stocks, but I want to be trading the quicker stocks when the volatility of the stock is really contracted, because then this is the point of contraction and expansion that you usually see the market go through. The market tends to contract, then it expands, then it contracts, then it expands. So I'm looking to trade the expansion here. My expectation is this stock should start to move out. So if my initial stop loss can be about half the average daily percentage move of the stock over the last 20 days, it is reasonable to expect the stock could then go up 2 times my initial stop loss, which, as you'll realize, is the magical free roll level to take 1/3 of the position out. Have I lost you? Probably. So let's start putting some numbers on it. So imagine here, I've split this into two parts, like the initial part of the trade and then the free rolling part of the trade. So let's say I buy 3,000 shares at $44.46, a penny above here, and we're going to get onto the limit on the next one. I want to keep it as relatively simple as I possibly can at the minute. So my total invested is $133,380. How? Because it's 3,000 shares times by 44.46. Hopefully it's following along. My stop loss is then going to be placed a penny below or a cent below the low of the trigger bar, which is going to be 42.95. So my risk is 3.4% and or $1.51 per share. So my total risk on the trade, and again, there can be gap downs where you then get knocked out at 10% or 15% because there's FDA comes out and rejects the application or something like that. If it's a biotech, whatever can happen. It could be earnings come out, whatever happens, right? But my risk on the trade, if I get stopped out here, how I am expecting this trade to plan out, would be $4,530. How do we get to that figure? Well, it's the 3,000 shares I'm buying, and each has a $1.51 of risk attached to it. Nice and simple, right? So now what I'm thinking about is the risk mitigation. So for me, there's 4 parts to a trade. There is number 1, identify, as I've been blabbering on about here. There is number 2, controlling a risk. There is number 3, risk mitigation, which we're about to talk about. So what I could do here is I could sell 1/3 of the position, which will be 1,000 shares, at 2 times where my stop loss is. So I could sell 1,000 shares at $47.45. This level here, this green level here, which is $3.02 per share, which is 2 times the $1.51 risk. Makes sense? Following along? So therefore, if we were to sell 1,000 shares at $47.45, that means we'd have a profit of $3,020. Why? Because we've sold 1,000 shares times by $3.02. Makes sense? So our remaining risk of 2,000 shares is 2,000 shares times by the $1.51. Okay, risk, because we bought 2,000 shares. Remember, we still have 2,000 shares that we bought here at 44.46, and the stop loss is placed here at 42.95. So there's still risk associated with those shares. So there's remaining risk. So 2,000 times by 1.51 equals $3,020. Isn't that interesting? So now we've got our profit locked in of $3,020 minus the remaining risk of $3,020 equals $0. So we have free rolled the trade, and we still have 2/3 of the position there, hypothetically risk-free. Of course, there can be gap downs, there can be slippages and stuff like that. I get that. But is this making sense? You're starting to follow along? So let's just play this forward 1 bar at a time. So here, we actually get filled here, and again, it's hypothetical. Imagine it's kind of perfect execution, stuff like that, which doesn't happen. That's why we're going to do some more examples where we're going to go a little bit more into the weeds. But on this bar here, what have we been able to do? Well, we've been able to enter it here. So we've had our entry here. This is going to be the entry. And then here, we've sold 1/3. 1/3 to FR, to free roll. Nice, right? So on the first day, the first breakout day that comes through, and this is the expectation, okay? Contraction and then expansion. Like this should happen through these trigger bars when a nice proper VCP sets like this, right? So then on this bar here, it's the entry and then sold 1/3 to free roll. So now they're risk-free on the remaining 2/3. So 2,000 shares with a stop loss at 42.95, but they're risk-free because I've locked in profit to offset the remaining risk of those shares. Now can I go and ride out a really big trend? So for me, I would then be, sorry if the noise clicking is irritating you, I would be riding the 10 EMA and also the 21 EMA. So this black line here, so 1/3 in there. 21 EMA is then the blue line. Ride it, ride it, ride it, ride it, ride it, ride it, ride it. There you go. That's the exit. But it's then risk-free from basically day one. Now, can you always free roll day one? Absolutely bloody not. But for me, how I like to trade is get in, free roll it, take all the risk out, sit for the intermediate term trend. And then if a spot comes where I could potentially add to it, so here it actually starts tightening back up. Look at this here. Look how the volume dries out. I could potentially pyramid it in and add to my position. Nice, right? Here we go. Let's go do another one, and then we've got 2 more to do, and these ones are then going to be a little bit more volatile, kind of biotech related stocks. But this one here, this one is a biotech stock as well, GTHX. Obviously with biotechs you have a lot of additional risk associated to them, as common sense would indicate. So let's say this stock here, right, GTHX. So this is a lower pivot, but it's not quite as straightforward to identify, maybe, because here it's not like that really nice, there was 1 contraction, 2 contraction, 3 contraction like this. This is one that's actually, it's made a good move here from about $20 up to $40 or so. It pulls back down, finds supportive action around the 21 EMA, so the 21-day EMA. See how it starts tightening? It basically builds this little Darvis box on there. It goes sideways for around about 2 weeks or so. Look how the volume dries up as well. So tightness in price, respecting a key moving average when the stock's in the context of a powerful uptrend has recently hit 52-week highs. That's stock I potentially want to be interested in and taking a look at. So then I'm looking for quote-unquote trigger bar, right? So here you go. Look how the volume dries up over the last couple of bars, and then it's pretty much back-to-back inside bars, and the ADR percentage of the stock is 7%. So the average daily percentage move excluding gaps on the stock is 7.0% over the last 20 days. So then I'm thinking about the risk. Now I'm going to confuse a couple of you here. So this is where we start thinking about buy stop limit orders and what I'm going to do on the next 3, but then I'm going to show you more thoroughly, I think, on interactive with brokers a little bit later on. So let's say this stock here, okay, it's pulling down, it's getting tight, the volume's drying up, tickety-boo, right? So the pivot for me would be 36.95, which is the high of this trigger bar. So if I bought it perfectly a cent above that at 36.96 and place my stop loss a cent below the low of this trigger bar at 35.55, my risk on the trade would be 3.81%. However, trading in the market, it doesn't usually work that perfectly. So what I'm about to teach you here, buy stop limit orders with stop losses attached, is much more the Nicholas Darvis, I'm sure many of you read his book, and the Stan Weinstein, I'm sure many of you read his book as well, way of doing things. So I don't like to use market orders. I like to plan my trade out before the market even opens, so I know what is the maximum amount I'm willing to pay for any shares, what is the maximum risk I'm going to have on those shares, where am I then looking to free roll it, assuming the worst case scenario that I get filled at the upper range of where the limit is. So let's break it through. So I use buy stop limit orders with stop losses attached and then a sell limit order for part of the position to free roll. Now that's invariably a third, sometimes it will be half, kind of depends how I'm feeling. I'm a human being as well and how the trade is playing out, other things I'm seeing in the market, other brother sister stocks, how are they acting as well. So here we go. What I'm going to say here is, okay, I want to buy this stock through the high of this trigger bar, which is 36.95. However, I don't want to get filled more than 1% above the high of this bar, which in this instance here is going to be $37.33. So if I get filled at $37.33, my risk on the trade, if I place my stop loss down here at 35.55, is not going to be 3.81%, is it? No, because I'm buying it at a higher price. My risk on the trade is going to be 4.77%. Now, why does that matter? Remember, there's 4 parts to a trade. There is identify, there is control, there is mitigate, and optimize. Now, clearly, we're very much focused here on the identify, the control, and the mitigate, specifically the control and the mitigate part. So therefore, I've got to know, how do I free roll if I get filled at 37.33 instead of closer to 36.95? So let's go through it. So let's say here, I buy 3,000 shares and my fill price, because I get filled at the upper end, so at the limit of what I was willing to pay for any shares, don't worry, it'll make sense, especially when we go across to interactive brokers, at 37.33. So this lighter blue line up here. So my total invested is $111,999. How? Because we have 3,000 shares times by 37.33. Hopefully you're following along. Then the stop loss is going to be placed at 35.55. So a cent below the low of this trigger bar, which is 4.77% or $1.78 risk per share. So the total risk on the trade, again, hypothetical, I know, is $5,340. Why? Because we had 3,000 shares and we have a $1.78 stop loss attached to those shares, making sense. So now we start thinking about the risk mitigation. So I'm planning this all out before the market even opens. I do my homework the night before. I already know what I'm doing the night before. I've planned it all out. I've done all my screening, done all my scanning, worked it all out, dialed it in for if there's any stocks I want to target, then I am literally going into this much detail, planning it out ahead of time. That's what I'm doing. So here, I'm going to then sell 1/3 of the position, which is going to be 1,000 shares at 2 times the initial stop loss risk. So remember, it was $1.78. So let's times $1.78 by 2, we get to $3.56. Makes sense? So we're going to sell 1,000 shares at $40.89. This green level in here, which is going to be $3.56 per share, 2 times the risk. So the profit is going to be 1,000 times by our $3.56 of $3,560. Our remaining risk, because we still have 2,000 shares left, is going to be the 2,000 shares times by $1.78 equals $3,560. Oh, don't those two numbers sound familiar? So our profit that's locked in of $3,560 from the 1,000 shares that we just sold at a profit at $40.89 minus the remaining risk, okay, of the 2,000 times by the $1.78, which is $3,560 equals 0. We free roll the trade. So now we've got 2/3 of the position left, risk-free, hypothetically. That can be, this is a biotech stocks, you can have FDA where they refuse applications and stuff like that, earnings come, whatever, right? But hopefully you're following along, that we now have no risk, but we still have 2/3 of the position. We've still got 2,000 shares risk-free. Nice. Now, do you have to do this? Absolutely not. You don't have to do this. But for me, I like to take the risk out. I like to trade risk-free, really manage the downside as soon as prudently possible. As soon as prudently possible. So let's then play this forward. Okay, we have a decent kind of breakout bar coming through in there. Let's then play it forward a little bit more. Again, do you always free roll in the first day? Well, actually on that day there, can't go back a bar. Let me just remove that one there. Let me then pull this one across. So see how, oh, we would have done it on the first day actually. But you see how even though, imagine it's this red bar here, using a sell limit order, even though price did not close at that level, price went to that level intraday. So that, for me, is why I like using sell limit orders, because if I'm not staring at the market and price goes to that level, because I have a life as well, if I'm not staring at the market and price goes to that level, then I'm still sold part of the position for how I was then planning the trade out. Nice. And then sit, try and ride the big intermediate term trend. Nice. EGRX, let's do another one. So here we go. What I'm saying is this stock here makes a huge move. Look at the earnings, look at the volume coming through, 52-week highs. This is also a little low pivot coming through down here. Look at the tightness. So it's through the high there, stop loss place there, nice. And then it builds this kind of little kind of cheat, cup and handle type banner, whatever you want to call it. It's an extremely strong stock that gets very, very tight. So price contracts, really nice to see. And the volume dries up below the 30-bar average. That is good. Look at the 52-week highs coming through on the relative strength line. Search my name in indicators, you will find it. I find it very useful. So huge volume, tightness and price is really, really, really good to see. It's a sign that there isn't much supply coming to the market, and supply that is coming to the market is being absorbed. That's how I think about it. So here, what we could say is we get this really nice inside bar. So through the high of the inside bar would be 37.39. Stop loss placed below the low of the prior bar, because let's say we wanted to get our initial stop loss underneath the 10 EMA, would be at 35.59, a cent below. So if we got filled perfectly a cent above 37.39, so at 37.40, our risk on the trade would be 4.84%, but that doesn't invariably happen. So this is why I use buy stop limit orders, because I'm controlling how much I'm willing to pay for any shares, which really helps me in terms of understanding the risk that I'm going to have on the trade, and then the risk management and the trade management side of things to take the risk out of the trade. So if I said I want to get filled within 1% of 37.39 through the high of the trigger bar, that would be 37.98. So the maximum stop loss that I'm going to have on this in terms of the max risk, if I get filled here at 37.98 and my stop is down here at 35.59, my risk on the trade is going to be 6.29% or $2.39 per share. Now that really helps me with the trade management. So let's go through it. So if I'm going to buy 3,000 shares at 37.98, okay, here, so I get filled, I use a buy stop limit order, price goes through that level, boom, it gets triggered, and then I get filled here at 37.98, and then my stop loss goes here. So my total invested is $113,940, 3,000 times by the 37.98 per share. My stop loss is at 35.59, which is 6.29%, $2.39 risk per share. My total risk on the trade is therefore $7,170 with the caveat you can have gap down slippages, all of that stuff. 3,000 times by the 239. Hopefully you're following along. So let's now go into the free rolling tactics. So what I'm looking to do is sell 1/3 at 2 times the initial stop loss to free roll the position. So I'm going to sell 1,000 shares at 42.76, which is $4.78 per share. Now why that level? Because if you times $2.39 times by 2, you get to $4.78. Makes sense? So profit is $4,780. Why? Because it's 1,000 shares times by the 478, but we still have 2,000 shares that have the stop loss attached. So this is the remaining risk element. So we have a remaining risk of 2,000 shares times by the $2.39 stop loss, because remember we bought them at 37.98. The stop loss is down here still on those 2,000 shares at 35.59. So our remaining risk on the trade is $4,780. So our profit locked in from selling the 1/3, the 1,000 shares higher, is $4,780 minus the remaining risk of $4,780 equals $0. Free roll the trade. Nice. Let's play it forward. See how then on this bar here, stock gets out like this. Let me just remove some of these like this. So the stock then gets out like this. So the entry is on this bar here, takes a day, then the position is free rolled, and then it's all about trying to sit and ride the big intermediate term trend. So then I've just utilized 10 EMA and the 21 EMA. Let's now remove this. This is still kind of first testing action. Maybe you take some off here, maybe you don't take some off here. Testing action, and then it starts going. So then it's literally for the optimizing profits, black line, blue line. You don't need to overcomplicate it. So there, if the entry is here, so we've had the entry plus free roll in this entrance, I'm just going to put FR just for brevity's sake. This would then be 1/3 off here. So we've got 2/3 left, so we've just taken 1/3 off, and then it would just be waiting for a close below the blue line. There you go. That's the trade. It's not that complicated. It's really not that complicated. And then if the stock resets, always can buy it back. Starts tightening back up, could always buy it back. But that is then the trade. So for me, I'm trying to get in because I'm expecting a pop, a testing action of the pivot, then the intermediate term trend. And I'm then trying to capture that to the best of my ability. So in my head, what I'm expecting is, well, I can just do it here. What I'm expecting is breakout. So pop, test, reversal on trend. And then I'm trying to ride the intermediate term trend. I'm not a day trader. I'm an intermediate term trend follower that likes to take the risk out of trades very, very, very quickly. Very quickly. ICPT. So let's do one more and then we'll go across to interactive brokers to explain it a little bit more. So here, the stock makes a huge move from about $72 up to $490-ish, $500, right? Something probably happened here. Maybe it was FDA approval or something like that for a new drug. Don't know, could have been. And then here you get your low pivot that forms. So look at how the stock respects the 10 EMA. Look at the tightness. It basically just builds this little Davis box on the 10 EMA. What do you notice about the volume in conjunction with the tight price action? There ain't much volume. So tightness and price, low volume tells you what about supply? There ain't much supply coming to the market. Okay, nice. So then you start getting really tight. Not you, but the stock starts getting really tight here. So you get this, what I call trigger bar action. It's a really tight bar. So the higher the trigger bar, I appreciate it's a little bit difficult to see because of kind of how volatile this stock was. But you take a look here. So 305.27 is the higher the trigger bar. Stop loss sent below. In terms of stop loss underneath below the trigger bar is 297.10. So if we got kind of perfect execution, 305.28 for the entry, and then the stop loss placed down here would be 2.68%. But again, you don't usually get perfect execution. So then what I want to say is, okay, how much am I willing to pay above the high of the trigger bar? So what is the maximum amount if price goes through that level I'm willing to pay for any shares? And let's say in this instance, it's 2%. So then what I'm looking to do is the limit attached to the buy stop limit order is 311.39. So if I get filled at 311.39 and place my stop loss down here at 297.10, my risk on the trade is not going to be 2.86%, 2.68%, it's going to be 4.59%. Now that's very important because I'm then working out kind of my worst case free rolling objective because I know the maximum amount I'm going to pay for any shares. So therefore it's going to be $14.29 risk per share. So times that by 2 gets to $28.58. Let's go through it. So let's say I buy 3,000 shares at 311.39. So my total invested is $934,170. Why? 3,000 shares times 311.39 per share. So my stop loss is then going to be at 297.10, which is 4.95%. So it's this one over here, which is going to be $14.29 per share. So my total risk on the trade is now $42,870. So now do you see when I have this risk on the trade, I want to get that risk out really quickly. Like I want to get out really quickly, okay? So here we go. This is how I'd be thinking about it. Sell 1/3 at 2 times the initial stop loss to free roll. So I can sell 1,000 shares at $339, which is $28.58 per share. Because remember, our risk on the trade is $14.29. Times that by 2, we get to $28.58. Nice. So we then have a profit of $28,580. Why? Because we've sold 1,000 shares up here at $339.37. So 1,000 times by the $28.50 that we were selling in terms of the profit per share is $28,580. But we still have 2,000 shares left. We still have 2/3 of our position. The remaining risk of 2,000 shares times by the $14.29, because remember we bought them here at 311.39. The stop loss is still down here at 297.10 cents. So our remaining risk on the trade is $28,580. So we've got the profit locked in of $28,580 minus the remaining risk on the trade of $28,580 equals $0. We free rolled the trade and we still got 2/3 of the position. Starting to make a little bit of sense? So here we go. On this bar here, the stock gets out really well. Now I'm just going to clean this up a little bit. So we then pull it across like this. So here, on the first day, able to get in, free roll it. So the entry plus free roll happens here. Plus, I'm just going to put FR to free roll. So on the first day, we've taken out that $42,000 worth of risk in, taken it out. Now I've got 0 risk, but I still got 2,000 shares left. That's how I like to trade. And then it's a case of black line, blue line. So you can see here, let's get rid of these ones. So I'm expecting, this is what I have in my head, the story that I'm then expecting through these low pivots. It could be a low pivot, a mid pivot, or a high pivot. But what I'm expecting is a pop, a test, and then a reversal. And sometimes you don't get the reversal. Sometimes you don't even get the pop and you just get stopped out on the first day. It happens. It's part of trading. But my expectation for this stock and then feeds into my trade management, into the optimizing profits, because we now worked through the first 3 phases of the trade. We've identified it, we've controlled it, we've mitigated the risk. Now let's optimize the profits. And for me to optimize the profits is getting the intermediate term trend right. So my expectation for this stock, which again, my expectations often aren't met, but my expectation and how I'm then planning to manage it is here: pop, test, reversal. And the test can sometimes come back down to the pivot. Oftentimes it does. So this is actually holding quite well. So let me then just play this forward. See how it tests, see how it tests, see how it tests. Now it's starting to reverse. So again, I'm not going to go really in the weeds here, but then I'd be adjusting the stop loss up to break even point or above, kind of in between where the testing action is and the pivot, depending on how it kind of plays out. But when I start to see the reversal, this is them reversing. So now I'm literally riding the black line and the blue line, or potentially going to choke some off if it starts getting extended from the 10 EMA being the black line. Maybe all of it, maybe some of it. Don't know, depends how the stock plays out. There you go. It's literally then like this. See how it's still going? There you go. See that change of character? Like there. That's the exit. That takes out the black and the blue line, and it's the reaction to the earnings. To me, that's the change of character. Out. Done. Nice trade. So from there to then sell those remaining 2/3 up there with 30% gain, not bad. Sometimes they go up 3%, sometimes they go up 30%, sometimes they go up 300%, sometimes you get stopped out 2 days later. It's the nature of the beast. It is lady luck. It is a variance of how these stocks play out. But that's the exit for me, because I'm expecting the stock to then potentially like rebase or just change character and it trends down like that. So you see how like efficient that is. So for me, that's what I'm expecting. Get in, ride the intermediate term trend, get out. Simple, right? So then in the second half of this video, we are going to be jumping across to Interactive Brokers. I'm going to show you how I plan out a buy stop limit order with the stop loss attached and then put the sell limit order in for part of the position. Okay, for part 2 of this video, I'm going to show you how I use buy stop limit orders with the stop loss attached and then utilize a sell limit order to help free roll mitigate the risk on the position. I got Celsius loaded up here. I've opened up a paper trading account on Interactive Brokers. There may or may not be a referral affiliate link in the comments below somewhere. It depends if I can be asked to find it and then actually put it in the comments section. I like Interactive Brokers. It's not a broker recommendation. You may not like it. Do your own research and all of that stuff. So Celsius here, I wouldn't actually be targeting entry here, but it's a stock that I'm watching. I think it's really strong, ticks a lot of the candles and boxes. So let me just walk you through a hypothetical example here if I was targeting on this day, which I'm not. So this line here, this is the 10 EMA, this yellow line / blue line when I hover over it, 10-day EMA. So Celsius, it's obviously in a strong uptrend, really good volume coming through this one, the earnings, powerful uptrend here, starting to pull back in. So let's say I wanted to target it through the high, stop loss underneath the low of this bar here, and then I was looking to free roll it. So okay, I need to work out what is the high of the bar, work out the risk as well. So the risk on the trade, if I just take a percentage, is going to be around about 2.93%, probably when we factor in a little bit of slippage using a sell limit order as well. So we're going to be looking to free roll just off of this chart here. But let me take you through it. Let's just delete that trend line. So we've got Celsius. So I'm going to look to buy, let's say 3,000 shares like this. So 3,000 shares. I don't want to use a limit for this. I want to use a buy stop limit order. So the stop is going to be the trigger price. So the high of the bar here, if you take a look down here, you'll have the high, the low, and the close. I'm most interested right now for this bar here, the high of the bar and the low of the bar, because that's going to help me define the parameters of the trade. So the high of the bar there is 150.23. So that's going to be the trigger, 150.23. like this. Now the limit, let's say I want to go within a percentage point. So what I'm going to do here is go 150.23 and I'm going to times that by 1.01. Now I may go for 1%, I may go for 0.5%, depends. If you wanted to go for 0.5%, it would be 1.005 for 0.5%. Now I plan all of this out on TradingView. I find it much easier than I literally come over here when I know all of the different parameters in terms of levels for where's the stop, where's the limit, where's the initial stop loss, then where is the sell limit order and kind of the range of the sell limit order going to be. I do it all on TradingView, then I literally come over here and type in the figures because I find it much easier to do. But let me show you here. So the limit, if we were to looking to buy within 1% of this bar, would be 151.73. So then what I'm going to do here is go 151.73 like that. Nice and easy. Now I need to attach a stop loss, and I will keep that on a day basis. I don't want to do that on a GTC basis because I do my homework the night before getting ready for the next session. So again, if I then like Celsius the next day, I will just put the order in again, and it may change because the highs and the lows of said trigger bar or not, as the case may be. But here, attach stop loss. So I want to click attach stop loss. Now I want to tick this here, but my stop loss, I want it on a good till cancel basis. Why? Because if I just do it on a daily basis, I can get filled in the position, but my stop loss is on a daily basis. So at the end of the session, Interactive Brokers will cancel my stop loss order. So now I can be filled on a position with no stop loss. I don't want to be that. That's why I keep my stop loss on a good till cancel basis, but it is only good till cancelled if the position gets filled. Make sense? So now what I want to do is place my stop loss a cent below the low of this bar. So the low of the bar here, take a look at this figure down here, the low of the bar is 146.32. Nice, so I want to go penny below that, 146.31, like this. So now I'm just going to go submit on the order. Obviously the market's not open and all that stuff, so it's going to ask me a whole bunch of questions. Yeah, absolutely fine, all of that stuff. There we go. So now the order is in. The buy stop limit order is in here. So the buy stop is the high of that bar there, 150.23. But remember that we're looking to buy it within a percent of it. So that's going to be 151.73. And then our stop loss is placed down here at 146.31, a cent below the low of that bar. So now I have to figure out my free rolling level. So I'm going to assume a worst case scenario. So what I'm going to do here is I'm going to go across, this is obviously my limit here of 151.73. So I'm just going to type in 151.73 like this, and then I want to minus the stop loss. So I want to know how much risk am I going to have. If I get kind of my worst case scenario in terms of the fill, how much risk am I going to have maximum on the position? So let me go minus my sell stop here of 146.31. This is exactly what we're doing on TradingView. Just takes a little bit longer doing it like this using the calculator. I'm not that quick at math, so I can't do it all in my head. So $5.42 is the risk that we're going to have per share if we get filled at the upper end of our limit. Now that's very important to me because then I want to know where is my sell limit going to be. So I need to go at 2 times this level. So 1/3 at 2 times the risk. So what I'm going to do is just times this by 2, which is going to be $10.84. Now what I need to do is just then add this to the limit price, which we were saying, so I can just come in here and I can double check it, 151.73. So plus 151.73 like this, that's going to be 162.57. So now what I'm going to do is come back over here, Celsius. I want to go a sell limit order for 1,000 shares, which is going to be 1/3 of the position for 1,000 shares. And the limit is going to be this level here at 162.57, like that. Now what I want to do is do that on a daily basis, not a good till cancel basis, but I just want to save the order. So I won't submit that until my order, my buy stop limit order, is actually filled. So I'm just going to click advance and then I'm going to go save, because this is also the worst case scenario for me, because I may not get filled at that level of 151.73. I may get filled below it. I may get filled closer to where my buy stop is at 150.23. Maybe I get filled at 150.50. So therefore my stop loss is going to be less. So I don't need to be looking to free roll at 162.57. It may be 160. It may be 159. It really depends how it kind of plays out basically. But then we can see the risk on the trade, and then that is then working out for how we then free roll the trade like that. So the sell limit order, I won't submit it until I'm in, and then I know the actual sell limit order. So then I do a quick calculation. I have the benefit of being able to stare at my screen most of the day. So I appreciate for those of you with time zones, work commitments, family commitments, whatever, it's much harder to trade like this. So I found something that works for me and suits my personality. It may not work for you. It may not suit your personality. It just is what it is basically. But then once I'm in, and then when price hits, if and when price hits the sell limit order for 1,000 shares, I then have to go back in and then update my stop loss, okay, to my new position size. So it's not going to be 3,000 anymore. I have to then manually change that to 2,000 instead of 3,000 shares. Otherwise, if price then comes back down here to 146.31, I then get knocked out. But then I find that I'm short 1,000 shares at 146.31. So you then have to manually update it. That's the thing about interactive in brokers. But that's it, guys. I will wrap it up there. I hope you found that video relatively informative. I don't think there's many things out there like this in terms of actually thinking about different order entry strategy in terms of buy stop limit orders, and then how I get in, where I then look to place the limit, where I then place a stop loss, how I then utilize the sell limit order for part of the position. Now up here I was indicating 1/3, but it may be that I want to sell half the position at 1 times the initial stop loss to free roll, or maybe I want to sell 1/3 of the position at 3 times the initial stop loss to free roll. Kind of depends on the market as well. I don't want to go too much into the weeds in these videos, but that's it, guys. I'll wrap it up there. Thank you very much for watching, and I look forward to seeing you in a future video.